All right, so welcome to the screencast for Section 3, Part A in Chapter 9 on competitive markets for goods and services. I've split Section 3 into two sections, make it a little more bite-sized chunks for you to watch so you don't have to sit here and watch everything all at once. The learning objectives are for you to be able to distinguish between economic profit and accounting profit. I mentioned that earlier, but we're going to get into that a little bit more in this section. And you should be able to explain why, in long-run equilibrium, in a perfectly competitive industry, firms will earn zero economic profit. One of the differences between what we're doing here in Section 3 and in Section 2 is this is a long-run consideration. So if a firm is earning lots of profits, it's going to encourage competitors to enter into the market. If firms are losing a lot, it's going to encourage firms to leave the market. So we're going to allow that to happen in this long-run model. First, let's talk about economic profit versus accounting profits and losses. Economic profit, again, is total revenue minus total cost. Cost is opportunity cost. All right, so we include what the firm is not getting by producing the things that they are producing. All right, so accountants and accounting cost and business cost in a lot of classes and in real business only includes explicit cost in their computation. So it includes how much do I have to pay for labor, how much do I have to pay for capital, how much do I have to pay for the factors of production. So cost in an accounting sense only takes into account how much you have to pay out for labor, capital, and natural resources. It's explicitly what you have to pay on those other markets, all right? So there's also, for capital, there's an estimate of depreciation. Don't worry about that too much. That's for accounting classes. But it's, again, the idea is that you paid something so much for this machine, but the machine gets less and less valuable, so you can take that off as a cost. All right. Profit for this, in this sense, is only computed using those costs, what you paid out. It's a measure of the profit. This is the measure of profit that firms normally talk about. It's their expenditures. They take the revenue they get in and they subtract their expenditures, and that is their profit in an accounting sense. What do economists add to that? Well, we recognize that there's another cost that the accounting sense doesn't account for. We include what else could you be doing with that capital, land, and natural resources. You could be producing something different that would have a different amount of revenue. So we are including those foregone income, that revenue you don't see because it's a second best thing. We include that when we're thinking about economic cost, all right? So suppose the most valuable alternative use of our firm's land, the radish farmer we've been talking about, would be to produce carrots, all right? So the income that we forego by not producing carrots is an opportunity cost, and economists include that in their measure of cost into total cost. So that's why we keep saying zero economic profits, and people are like, well, why would a firm operate for zero profit? They're making accounting profit. They're making money that is the difference between the revenues they make and the cost that they spend. They're making that revenue, that difference in revenue and cost, but when you take into account the opportunity cost, then that is where, in a perfectly competitive market, we say there are zero economic profits, all right? So let's look at this long run and zero economic profit. Given our definition of economic profit, in a perfectly competitive market, they must always be zero in the long run, all right? And the rest of this screencast, we're really going to be talking about why that must be the case. But here, think about it this way. There are two industries in the economy, and firms in Industry A are earning huge economic profits. Firms in Industry A are earning a greater return than is available in Industry B because they're earning big economic profits, and in Industry B, they're earning zero economic profits, all right? So what that would happen is that firms in Industry B would start to think, well, why don't we move into Industry A? Why don't we go into that other market and make positive economic profits? So easy entry and exit will give firms in Industry B the ability to come in to Industry A and earn greater profits also. What will that do, though? Well, that means that over time, those extra big economic profits should be driven down to zero, all right? So here it is in a graph. So imagine that the original supply curve in this market is S1, the original demand curve is D. That gives us a price per pound of 40 and an equilibrium quantity in the market of 10 million pounds of radishes. Just like before, this graph on the left-hand side is the, well, maybe it's your right-hand side. The graph over here is the market graph, and the graph over here is for our representative individual firm. So our firm here initially is making a marginal revenue of 40. Again, price equals marginal revenue for the firm. So they can sell as many as they want at 40 cents, and their marginal revenue is just the price times the quantity that they just, the marginal revenue is just the price. Each additional unit they sell, they get that marginal revenue. Where would they decide to produce? Well, here we've also drawn in their marginal cost curve and average total cost curve. We said that the firm maximizes profits where marginal revenue equals marginal cost, all right? As long as that's above average variable cost, which we'll leave to the side for now. So here, the firm is going to produce at 6,700. This is the same result we had before. And as we said before, their profits are 938. They're making 14 cents per unit, and they're selling 6,700, so that's a profit of 938. What's going to happen, though, in the long run is that firms are going to enter this market. Other firms, besides this one firm, are going to enter the market. What will that do? It will shift the supply curve down to S2. All right. Lots of new firms enter the market. They want to supply the good at 40 cents. They want to supply a lot of it, but what does that do? It shifts the supply curve down, and so we get a new equilibrium price here of 22 cents. The new equilibrium quantity in the market is 13 million pounds of radishes. What has that done? Well, 22 cents is now the marginal revenue curve for our original firm. All right. So what has happened is that now marginal revenue is here. They want to produce where marginal revenue equals marginal cost, and so they want to shift production down to this level. Marginal revenue equals marginal cost right here. Right, correct. All right. So that's what happens when entry drives down profits. Notice that at this point there are no profits. Marginal revenue, there's no difference between average total cost and marginal revenue. So here, average total cost and marginal revenue are equal at the point where marginal revenue and marginal cost cross one another, so there's no profits left. So the entry of other firms drove the price down so much that we got to a point where there are no longer any economic profits left for our original firm. All right. We can also look at this on terms of losses. What if firms are losing lots and lots of, having lots and lots of negative profits or losses? So start here with the demand curve here at D and a supply curve here at S1. So our original price here is P1. The original quantity in the market is Q1. So that means for our firm, marginal revenue is at MR1. So they want to produce where marginal revenue equals marginal cost here at Q1. But notice this is way, way below the average total cost. So their profits are actually not profits, they're losses. They're losing this entire green area here. All right. So what happens when firms are having losses? Well, firms are going to start to leave the market. All right. And when firms leave the market, the supply curve shifts in. It contracts. There's now less supply. What is the effect of that? Well, the big effect here is that price rises to P2. Firms that are producing leave the market, the price goes up, but the quantity, equilibrium quantity for the market falls to Q2. All right. What happens over here? Well, now marginal revenue goes up to MR2. The firm wants to produce where marginal revenue equals marginal cost at Q2. All right. But notice, what is the profit here? Well, the profit is the difference between marginal revenue and average total cost. The profit is 0. Again, we came at it for the first side, we said the firm was making a lot of profit and it got driven to 0. In this slide, we said the firm starts by making a loss, firms leave the market, and eventually profits go back to zero. So both losses and profits and losses will get driven to zero as firms leave and enter the market. All right, so that's the end of this screencast. We have one more for this chapter, Section 3, Part B, and it'll be up next.